Should you buy property in your own name or limited company? The quick answer is yes. You should buy a property investment within a limited company. So if that's all you wanted to know, please smash that like button before you go and subscribe if you want to see more from me. But if you want to know more in this video, I'm not going to bore you with the detailed calculations and spreadsheets of how it works. Instead, I'm going to go through the simple basics that have helped thousands of investors we've worked with within my property company over the years make the right decisions for them. I'll break down the pros and cons, and at the end, offer a free tool we link our clients to that can help you make a 100% right decision for you. So let's get into it. If you're a basic rate taxpayer, so you earn less than £50,270 a year, and you expect to stay that way long term, even after you add all your extra income sources from property investments and other investments you may have, then I lied to you at the beginning of the video, and personal ownership is likely to work just fine for you. It doesn't mean you can't still buy properties through a limited company if you want to, but it isn't likely to create any financial benefits for you and probably add a bunch of admin. Despite this, I'd still personally buy property within a limited company, because although you may be a basic tax rate payer today, you may want to earn more in the future. And as none of us can accurately predict the future, obviously, it seems a shame for you or any of us to close the door on the potential benefits of owning property through a limited company, which I'll get into a bit later. On the other hand, if you are a higher tax rate payer, so you earn over £50,270 from all of your income sources, so not just your salary, but including any income from other investments, and you expect to continue earning above this threshold into the future, then buying property through a limited company is almost always going to be the best thing for you. It would be stupid not to, especially if you also like the idea of building generational wealth, passing your wealth to future generations, or you already own a business and your money to invest is coming from there because you can lend money from one business to another pretty easily. So that covers the basic headlines to help you make a decision. And if that's enough information for you so far, then obviously don't forget to like and subscribe before you leave. But if you're interested in understanding these answers a little bit more, I'll briefly take you through the pros and cons. So let's start with the negatives of owning property through a limited company, because I speak to a lot of people about this and a lot of people don't actually think there are always downsides. However, there are the odd ones to bear in mind. The first downside is interest rates of mortgage products do tend to be a little higher, roughly 1 to 1.5% higher than buy-to-let mortgages if you were to take them out in your own name, even though you'll almost always need to sign a personal guarantee on any mortgage through your limited company anyway. So currently, the Mortgage Works offers 2-year fixed rate 75% mortgages at 3.64% with a 3% product fee if you're buying a buy-to-let property as an individual, or you're getting a product as an individual, compared to the same 2-year fixed rate 75% mortgage costing 4.99% with a 3% product fee when you're getting that same product through a limited company. So there is a difference, which although it may seem silly to you to pay more for the same thing through having property through a limited company, I'll show later how the tax benefits of owning property through a limited company can more than make up for the higher interest costs that you'll get through the products you have. The next negative is the mortgage applications are more complex with buying through a limited company. So even though you are getting the mortgage through a company, you'll still need to provide things like personal guarantees, like I mentioned earlier, which in short means that if the company stops paying the mortgage, the lender won't just stop there. The lender will then go after you to cover that mortgage. So it's essentially in your name. Because of this, you will have one solicitor sorting the mortgage for the limited company, but you also need another solicitor for the personal guarantee. It needs to be certified by a separate solicitor, so the lender can make sure you have received separate legal advice from that of your company. This of course adds cost and admin for you. Also, if you have multiple shareholders and directors in your limited company, a lender may want to go through the application process for each one of those people, which again adds time, cost and admin. If your immediate thought is that you want to be the only shareholder of your limited company and that doesn't apply to you in any way, then that may not always be the case, as you may want family members as shareholders or directors in the future to take advantage of certain tax benefits, especially for things like inheritance. The next downside is higher accountancy costs. So although you can self-manage and certify your accounts yourself, most of the time with a company you will want an accountant to perform all your annual filings and potentially produce and sign off your annual accounts for you. This is less of cost when you have a company with lots and lots of properties within it sharing one accountancy cost. But if you have a company with 1 or 2 properties, the accountancy cost is going to become a bit more of a cost overall and a bit of a dent from your profits. And finally, you get no capital gains tax allowance within a limited company to use when you sell a property, which at the moment stands at £6,000 tax-free allowance. However, this allowance has reduced and reduced over the years, so it's likely to continue being less and less of a factor in the future, especially if you plan to hold your property investments long term, even hold your property investments across generations. So if right now you own property investments and you don't hit the earning amount to need a limited company, it probably isn't worth the hassle to restructure your property portfolio, or if you plan to hold a small property portfolio long term and earn below that threshold long term, then again it may not be worth setting up a limited company, because you are opening yourself up to high lending costs, more administration and accountancy costs, and you lose that capital gains tax allowance we talked about earlier. However, there are some great benefits to owning a property through a limited company for investors that, if they apply to you, will make your decision a no-brainer. So let's get into the benefits. Just before we do, if you found this video helpful, please hit the like button and consider subscribing. It really helps me out and will make it more likely you'll see these sorts of videos in the future. So let's get into it. The benefits of owning property through a limited company is firstly the tax benefits. Paying too much tax is the worst cost you can put yourself through. The tax charged to limited companies is called corporation tax, and currently that sits at 25%. So if you're a higher tax rate payer at 40%, then the tax your company pays is far lower than the tax you would pay. If you're a lower 20% taxpayer, then of course 25% corporation tax is higher. This is why limited companies don't work well for those that earn less than that £50,270. However, if you are a 40% taxpayer, so you pay more than that, your company's paying just 25% tax instead. And that could be a massive saving, leaving way more profit left over after tax for you to reinvest in more property, which helps you grow your property portfolio quicker and compound value quicker. The other main benefit is you can claim your mortgage interest as a cost. So if you have an interest-only mortgage, which most landlords do, then you can claim the entire mortgage cost as a cost for tax, which reduces the tax you need to pay. As an individual, you cannot claim your mortgage interest as a cost. So you are taxed on your mortgage expense as if it is profit instead. So for example, as an individual, if your mortgage is £100 a month, you are taxed on that cost. So as a higher rate taxpayer, you'll be taxed 40%, so £40. As a lower tax rate payer, you'll be charged 20%, so £20. However, the added complexity is the government gives a 20% tax credit. So if you're a lower 20% taxpayer, you don't end up paying any tax on the mortgage cost because it offsets your 20%. If you're a 40% taxpayer, it reduces the 40% tax you pay on the mortgage to 20%. So you would be charged £20 on the 100% mortgage cost. This is the main reason why higher taxpayers should buy properties through limited companies, because this tax paid on your mortgage costs does not exist with limited companies. In conclusion, if you earn more than £50,270 across all your income streams, or you expect or aspire to earn more, then buying property through a limited company is most likely the best choice for you. Not only will it save you on paying unnecessary tax, it will allow you to build profits within your business where you will be paying the lower 25% corporation tax rate that allows you to reinvest into more and more property, or even lend it to other businesses in the future. Also, if you own another business, you could lend retained profits from there to your property investment limited company in a more tax efficient way as well. If you have any questions, please throw them in the comments below, and I promise to try and answer all of them. If you'd like more inspiration on how to make money through property, you can watch the next video up here, as the YouTube algorithm predicts you're probably going to like it. But don't click on it just yet. Make sure you subscribe if you want to grow your wealth. I'll see you over here.